Right, guys, so welcome to today's video. We're going to be covering everything to do with the daily bias, and not just in the way that you're probably most used to, where it comes down just to price action and a couple of patterns and stuff like this. No, we're really going to break it down from a perspective of what I like to call the macro flows, where you're looking at your higher time frame direction based on macroeconomic factors. Where we'll then look at the tools you can use on your daily chart to, to apply your technical factors to the chart and see what are the most probable areas that price will inject liquidity from. And then we zoom in even more and then start looking at our daily playbook. So we're going to start from a very broad perspective, zoom in, and really knuckle down on how you can improve your understanding of the daily flows and daily bias in the market. So the first thing that I am going to focus on today is macro flows. So the first thing we want to understand when it comes to forming a daily bias is the macro flows. And what macro flows, or what understanding macro flows does for you, is it helps you to understand the environment that you're trading in, whether you're in, let's say for Euro USD, whether you're in a bullish environment from a macroeconomic perspective, or whether you're in a bearish environment from a macroeconomic perspective. And once you've got that, you have your overall direction that you want to be trading in, and then you want to be aligning your technicals with that direction. So what actually contributes to macro flows? And when we talk about macro flows, we're talking about large funds, right? Think about wealthy individuals that are looking to put their money somewhere to allow it to grow in an environment which will allow that money to grow. So large funds, wealthy individuals, this is what they're focusing on. So interest rates, economic health, geopolitical condition, trade flow, and capital flows. These are important factors which show the trajectory of an economy, right? So interest rates is focusing on, you're looking at a currency. Each currency has an interest rate, right? And the interest rate tells you how much it costs to borrow a certain amount of currency. The higher the interest rate, right, the less attractive it is for a country to borrow that currency, or an individual to borrow that currency, but the better it is for an individual to invest in that currency, right? Economic health, you're looking at GDP. If a country is increasing in GDP, it most likely has a good economic health, and people are attracted to that economy. Geopolitical condition, when geopolitical conditions are unstable, or where there's something going off, like the recent situation with US and Iran, emotions will take over the market, and the market will be driven on emotions more than it is macroeconomics, right? Usually in conditions where geopolitical tension is low and the market is pretty normal, right, without any geopolitical mess going on, then you will see that everything follows the macroeconomic sentiment very well. However, when geopolitical tension steps in, you see that it becomes a lot more sporadic, and it doesn't follow the economic condition between two economies as much, right? And then trade flow and capital flow, you're looking at imports and exports, how much an economy makes from its importing and exporting, right? So like US, heavy importer, heavy exporter. China is exporting quite a lot. You're looking at how much money they're making from their trade flows. And then capital flows is where an economy makes its money from foreign investment, right? So they, like the US, again, it makes a lot of money through foreign investment, just because of the state of that economy over the last however many years, right? You've had a lot of money flowing into that economy, and yeah, that's what capital flows is. So you always, whatever currency pair you're trading, you always want to know the macroeconomic state and the economic state of those two economies, so you can compare them, and we'll compare the two together, so you can see which one's doing better than the other. Because usually what you'll see is the one that's doing better will have higher interest rates than the other, you'll see more money flow into the fixed income markets, in particular of those economies, right? You'll see capital flow begin to increase in those economies compared to the one with lower interest rates, meaning that the currency pair between those two economies will rise, depending on the base and the quote, right? So I'll show you this in a minute, but you always need to be up to date with the economic condition or with the US economic condition, as the US dollar makes up 90% of all FX transactions. So if you read the most recent triennial report by the Bank for International Settlements, you'll see that I think it was just above 90% of all the transactions made in FX are made up the dollar takes up the other side of that transaction. So the FX market is heavily influenced by the US dollar. Therefore, you want to be up to date very much in these realms with the US economy, right? It will tell you a lot about the marketplace. So as you can see here, these factors very much set up the macroeconomic tone for your currency pair, right? So for an example, let's say this is your y-axis and this is your x-axis, and we're measuring rates here, right? If the Eurozone is decreasing its rates and the US is increasing rates, right? What will happen, and this here is called your yield spread here, right? What will happen is that investors will borrow money in this low rate economy, right? Or withdraw money from the low rate economy and put it into the economy with higher interest rates via, again, the bonds market, fixed income. This is a horrible arrow, but it will invest into this economy, right? And then as you see, you know, and again, it's because they're going to make more interest. So let's say the interest rate here on the euro, completely hypothetical, is 1%, and the interest rate in the US was 4%. You see the difference is 3%, and this is what the investors would pocket by borrowing in this country and then investing in this economy, right? Hope that makes sense. And then what you'd see is the euro dollar pushing higher, right? So again, if it was the other way around and this was the euro, sorry, have I said that right? If this was 4% for the dollar and this was 1% for the euro, you'd see the euro dollar chart go down, right? Because you're looking at the value of €1 against the value, sorry, you're looking at the value of the euro against $1. Sorry, completely wrong. You're looking at how much €1 is worth in dollars. There we go, we got there in the end, right? So as the demand for this currency increases, it makes it stronger against, as the demand for the dollar increases because it has higher interest rates, right? And people are pushing money into that economy. The demand is going to push the value of the dollar higher. It makes it stronger against the euro, meaning that less dollars will buy you more euros. The dollar is worth more than the euros, right? So if the dollar's getting stronger against the euro, meaning the euro is getting weaker against the euro dollar will start to go down, right? I hope that makes sense. So we've now set our macro tone. Once you have, you know, and it's difficult to do this. The same way you study charts, you need to study macroeconomics and build up the skill of being able to read, you know, your macro tone via your CPIs, your PPIs, your unemployment rates, all these things, right? You're looking at your market movers in each economy and using that to read the health of the economy, right? Your Fed rates decision, be up to date with those. They meet 8 times a year, understanding which one of those they're setting rates. And yeah, these are things you need to be very much aware of. So Yeah, so let's say, right, that we go to the euro dollar, and let's say around this time here, we say, cool, we're expecting the euro dollar to decrease in value for whatever macroeconomic reason, right? We're expecting the rate, the value of the dollar to appreciate against the value of the euro, right? Meaning that the euro dollar should go down, right? Now that we've set that environment, right, we've got macroeconomic reasoning behind it, we want to align the technicals with that. So if we play price here, boom. So we're getting lower prices here. And this is where your standard technical analysis comes into play. So we're saying, cool, we anticipate a lower a lower euro. We've got sell side liquidity here. You've got your buy side liquidity up here, right? You can take this because this is the top end of your range. So we've made a high. We've made a high, we've taken out a low, and we've made this new low down here, and we've got a raise in place. All right, bang, bang, bang. We also have this volume band right here as an array. So these are areas that we can look for liquidity to be injected again into the market, right? We need some kind of low to be confirmed here, which gets done pretty high up. Let's just read the order flow here. Do we take that out? Okay, I'm happy to call that the low. So this is our dealing range low, right? These should be technicals that you are familiar with if you are used to my content. So now what we can do with this is we can say, cool, this is the high of our dealing range, this is the low of our dealing range. And what we have now are a premium and discounted area on our chart. If we want to go short, we want to be shorting in areas on our chart which are deemed as expensive, because this is where sellers will step in, right? We don't want to be shorting in discounted prices because buyers are still eager to step in, or sellers are still eager to step out in this condition, right? So what you have to understand is that even though there's a macroeconomic sentiment of price being bearish, number one, you have cycles in between that, and you have data points which can come out and in the short term go against the overall direction. But if the overall direction is bearish, sellers are going to continue to step in at areas where the price is deemed as expensive, right? As a premium. So we're using that dealing range and we're saying, cool, where can price step in at? We've got this bearish imbalance. We've got this area of volume on our chart. One of these two areas we're looking for price to push lower, right? In my opinion, we'd be looking at something like this. I also think that's just because I remember this happening. If not, then it's this one, right? That's our only two arrays and they both form in the premium end of that range. Cool, we've tapped into that now. We're looking for bearish intent back to the downside. Right, look how we tapped into that EQ. And now we get that bearish dump lower. So we set a new range, right? So we can get rid of this. And we're setting a new range. So we've got, and then obviously you have to be looking at higher time frame draws on liquidity. So your weekly time frame, your model, your sell model targets this, right? So you're bearish. You're aligning that with key levels on your chart, sell side liquidity, right? We're going to highlight this as main DOL. We're doing the same thing that we're doing on our daily, but on the weekly. I'm just not going to do it because it will be here forever, right? But this is our main draw. We're going to keep that on. Make sure that's on all the time frames, right? Drop down into our daily. So this is where we're looking for price to lock into. So we're now dealing with a new dealing range, right? We're respecting bearish arrays from this one here, right? We're printing new bearish arrays in the form of this bearish order block, bang. We are taking out previous lows, sell side liquidity. This is very much bearish, in line with our macroeconomic sentiment and environment, right? Again, theory-wise. And it's not as easy as I've made it out to seem in terms of the macroeconomics side of things. I've made it very simple for you to understand, but there's so many different factors that go into that play. But again, just to keep it simple and to give you some insight into what you really should be doing on your charts, right? So again, we're looking at the dealing range. You either got your main dealing range, even though this low doesn't seem to have been fully confirmed yet. You're looking at this being your buy side liquidity, or you look from your actual impulsive leg. So what I mean by that is you can also take this as your dealing range high, because this was the actual high that broke price lower. Doesn't mean anything too significant. You just end up with two different areas on your chart that you can use as a dealing range. I'm going to keep this one on, right? And what we want to see is price make some kind of solid low. Okay, cool. So we've got this solid low here, right? This is clearly a dealing range low. You've got your EQ up here. The imbalance, we're running liquidity here, so we may not need to tap into that order block, but we're so close, right? So we just want to see price starting to top out anywhere between this buy side liquidity level, right? This daily high over here, and this OB. So I'd be looking at something like that, right? Again, it falls into the premium area of our chart. Okay, close, right? Close. But you can see that this was from that order block, right? We don't break above the pressure point of that order block, which is the body of that, the body close there. You see how we wick above that, stay below, wick above that, stay below, wick above that, drop, right? So we respected that order block, we push lower, right? We come into EQ and we dump. So we're making a new range. And now bear with me, because the next part of this is going to show you how you can actually use what I'm about to teach you, like the daily playbook, which is the next concept, and use it to trade this. So this, again, these are your big swings. You're looking at, okay, cool. Here, when price is retracing here, your shorts are low probability because you're waiting for that EQ and your array to get tapped, right? Once price taps into that array, you can start to say, okay, cool, now we're going fully bearish and our highest probability conditions are short. Right? You're setting that tone and it's in line with your macroeconomic sentiment. Again, we pull back into the EQ of this dealing range, tap into the bearish array, in this case, an order block. We shift short. Now we can start playing shorts, right? Sooner or later, we're going to have to get a pullback. And you know that in that scenario, your shorts become less favorable and you want to be trading towards your array, right? So let's see what happens here. Remember, this is our main draw still down here. So we just miss it. But we're not sure if that's our actual low just yet. Now we have new arrays, right? Bearish array. We've got sell side liquidity, just got taken out. Right, and then new dealing range. We're not sure if that's our actual low just yet. So we've got to be very cautious as such. Okay, so we're most likely going to trade towards this drawn liquidity. Yeah, bang. So you see, notice how on our larger, this is the fractal nature of price. Notice how we've done buy side, sell side, right? Within that sell side, we get sell side, buy side, sell side, buy side, sell side, buy side, right? So within that one price swing, you get multiple price swings. Look, buy side, sell side, buy side, sell side. Buy side, sell side. It's patterns of self-similarity. The larger move is made up of the same move, but multiple times on a smaller perspective, right? So the move that you look at like this, which is higher high, higher low, higher high, is made up of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. It's fractals, patterns of self-similarity, right? So now we've traded to that drawn liquidity. What we'll most likely see is price have to pull back soon because we're taking out multiple levels of sell side. So this should be a low, right? And now what you're looking at is your EQ point here. So we don't want to be selling anywhere in this discount. Like this here, this is too low. As much as this is an area where sellers once stepped in, they're most likely not going to be willing to step in again here because this is relatively cheap, meaning that buyers should overwhelm the sellers there. So no reaction, and we induce it. We induce it, meaning it gets disrespected. What's our next level? Order block, which this isn't the greatest order block, but you've got an order block and you've got EQ here. Bang, right? Order block gets respected, taps into EQ. We're pretty much here today, right? This is like current price. Look how we just stagnate now. Taps into EQ again. Very liquid PA, which is indicative of that retracement, right? So look, these are the narratives you're trying to build in these on your higher time frames. Notice how when price is pulling back, you get no imbalances left to the upside. Price is liquid. There's no intent behind this move, right? And then when we move down with intent, we get imbalances. And then when we pull back and retrace, no imbalances, right? No intent, liquid PA, rebalancing. And then we get injections to the downside, imbalance, right? And then we pull back, retrace, no imbalances to the upside, no imbalances. That should click so much for you. That should be a huge click in your brain, right? So now sooner or later, what we should see on the euro is price either, dump from here, or we're going to need to run liquidity again, potentially tap into this bearish array up here in that premium, and then dump lower. But we're looking for price to top out here, take out this sell side liquidity. That's our main objective on the euro. So that is how we use the macro sentiment in line with technical analysis, right? That's how you build higher time frame context. You build an environment which you want to be trading in, right? If your view on the market is cool, that the dollar should be appreciating against the euro, meaning that euro dollar should move lower, we want to be trading in line with that, and we're lining up our technicals with that. Make sense? Now that we understand that, we can move over to our daily playbook. So how do I want to go about doing this? I'm going to delete all of this. But look, we've built that context in our head here, right? Of how we do our higher time frame analysis. So let's go back to here. Sorry, here. So the daily playbook is based on the fact that daily highs and lows act as liquidity pools, which you can use as targets for your intraday trading, right? Daily highs and lows are very objective areas which are deemed as expensive and cheap, because you can go to the next day, let's say tomorrow, you can look back and say, for this time period of the previous day, these were the prices which the market deemed as expensive and cheap for the day. So the next day comes along. If we trade into that area where price was deemed as cheap, we can anticipate two scenarios are going to happen. Either this is going to be deemed as cheap again, and buyers can step in, or we can see it as this isn't cheap enough anymore, and we're going to have to seek a new cheap area on our chart. So daily highs and lows are very important, and they become liquidity pools that price can trade towards and react from. So when we are bullish on our higher time frame scenario, as we just covered, right? What we want to be doing is targeting previous daily highs, right? Now there's two ways we can do this. You either get the scenario where price prints bullish, as it does here. The next day trades in between this high and low, but shows more bullish sentiment than bearish, right? We start to approach this previous day's high. We can anticipate that the next day's candle will expand towards this previous day high. If not that previous day high, then at least this one, right? But in theory, we anticipate that this will get traded towards. So if we're bullish and we see this, we want to be going long towards here, right? The next scenario, and the reason why we do this is because the closer you get to a draw on liquidity, the higher the chances that price is going to trade towards that, right? It becomes a magnet for price. Now in this scenario, if we've taken out the previous day's low and we fail to close below it and we reject it, right? And again, we start closing more or less above the 50% of this daily range here, so like that. This also is your draw on liquidity for the next day. So we expect the next day candle to look something like this. Bullish, right? So these are your two main scenarios that you're focusing on. Your bullish scenario 1, your bullish scenario 2. And all your bullish scenario 2 really is a liquidity grab and then trading towards the other side of a range. So let's say you've got some lower time frame price action like this. This is your sell side liquidity. This is your buy side liquidity. Your daily would look, or your lower time frame, your hourly would look something like this, trading towards this. This low being this daily low grab, right? And these are the playbooks that you're looking at. And then when you're bearish, it's the same but flipped. So if we get a daily print bearish, the next day prints bearish again, and we're approaching this draw on liquidity, right? We now want to trade towards this on the next day, right? So the next day that opens, we want to trade towards that. Again, in this scenario where we take out the previous day's high and we fail to close below, we want to start targeting this low and this low as our draw on liquidity, right? This is what you look at every day. And if your higher time frame is bearish, these two are going to be your highest probable trades, right? Or your highest probable blueprints that you want to be involved in. If you're bullish on the higher time frame, in conjunction with what we just previously went over in terms of the macroeconomic stuff and the technicals, if you're bullish on that, then you're looking for these kind of scenarios to play out. If it's the opposite, so if your macro is bullish, or in this case bearish, and you're looking at these scenarios playing on your playbook, this becomes lower probability. So you go in with less risk. Again, lower probability. Same here, if your macro sentiment is bullish and these form, these are lower probability. It's not that you can't take them, you just understand that it's lower probability and you want to be lowering risk in these conditions. Cool. So let's go over to the chart again and see how we can use that in this right here. So we're looking at this scenario. Here we have previous day's low, previous day's high, right? And again, you need to build a lot of context before doing this, right? Here, your standard mode or protocol would be to go short. This is your playbook that we spoke about, right? Look, you want to target this. But we know that we've just completed a sell side leg, taken out sell side liquidity, and now price is getting liquid again, which is indicative of what? We said it before, a retracement. We're failing to body close below this low, below this low, below this low, right? And then price is now, it went from this to sideways, which tells you that this is most likely bottoming out. So we don't want to be too eager on going short here just yet. You can do, low probability though, in terms of context. Let's see what happens. Cool. Now this is where it starts to get juicy because we're starting to flip bullish now, right? We body close above this previous high. Price closes up here. Your draw on liquidity for the next day is this high. Price fails. But now this stays intact because we haven't taken out any lows, right? Your draw on liquidity for the next day now, in this scenario, becomes these two highs, right? How can we get there? We can potentially take out this low. And if it does, we're trading towards this and this. So you have either price pushes up directly the next day, or we take out the previous day's low and then push up. But your draw on liquidity are these two highs here. Bang. Price takes out high number 1, high number 2. Now we get scenario 2, right here. Look how we take out previous day's high and we close bearish. We take out previous day's high and we close bearish. Draw on liquidity for the day now becomes this low. So the next day we want to see price trade to that low. Bang. Takes out that low, pushes higher. Now we've got the first scenario in our bullish context here, right? So that is open. So previous day here is 16613, and then this is 16611. So this is still open. What we're looking for is price to expand higher and take out these two highs the next day. Bang. Fails to body close above. Also, notice that we're in this bearish array, which we spoke about last time. We've got the dealing range. We're now in that expensive area. So we want to be cautious. So if price has failed to body close above this high, what scenario are we in? Fails to body close, right? But this one doesn't close bearish. So your momentum is not fully bearish yet, but we're failing to body close above. So we're now flipping our attention to this low. How is price going to get there? Either it's going to pull up and then drop, or we need to take out previous day's high and then move lower. Bang, we take that out. Now, where's our next draw on liquidity? Well, price fails to body close below this low. However, we know that in the larger scheme of things, we've tapped into our discounted area on our chart. We're tapping into a raise. So overall, we're back bearish again. So going bullish and targeting this isn't our most ideal scenario. What we want to see is price break down and potentially take this as our draw on liquidity. So remember, this playbook needs to be backed by context. So there's a potential that we could take this high, playbook-wise, right? Playbook-wise, we failed to close below this low. This becomes our draw on liquidity. But higher time frame context-wise, we're looking for this, right? So we know those two scenarios can happen. This one being more favored. Price leaving the high and coming to the low. Okay, cool. Now we get this range, right? Where we get this price closing in between these two, in between this high and low. Now notice how our reasoning was in line with that candle. We said that our macro is bearish. Our playbook calls for longs, which is 50-50. And you see the next candle prints 50-50, right? So now what we can expect is for price to dump lower and this be our draw on liquidity, or to take out these highs of the mother candle and then dump lower, right? But we're looking for bearish PA now. Bang, we dump lower. Next draw on liquidity, and this is our main draw now, right? This is that sell side liquidity of our sell model. We want price to break down. This is that OC, right? Original consolidation. Next day's draw on liquidity is this low and this low along with the previous day's low, right? We expand, we body close, but this is the one that wasn't covered in the playbook, right? When we close and body close below a previous day's low like this, right? This is too close of a DOL. So these become your DOLs. So we're now looking to target these lows. We got cooked. But now look, why? Because price took out the first DOL. Look, we tap into that, right? We tap into that. It fails to break lower. So it has to come to the previous day's high. But now what do we know, right? So we might have taken a loss that day if there was any kind of setup. But now we get playbooks. We failed to take out the previous day's high, right? DOL becomes previous day's low. Previous day's low becomes DOL. So we want to see price take out these lows and these lows. Bang. And notice how we don't take out the previous day's high, right? Bang. We're going to keep going through this. So now we're entering a new range, right? Remember we spoke about this in the macro topic. Sorry. So now we've got a new dealing range with this being your high, this being your low. Right, there's not too much you can work on here other than the fact that we've got a playbook where you've got your daily low getting taken out, price fails to close below, we push up above. The only thing is here is that you don't want to try and call a bottom. So you're just kind of waiting for more PA. This becomes your draw on liquidity in playbook theory. Bang, fell to close below, previous day low becomes your draw on liquidity. You're also looking at the fact that you have a bearish imbalance here paired up with your bearish OB. Overall, your context is bearish, so any long positioning will be low probability, any short positioning will be higher probability. So you can get shorts to this previous day's low. Again, doji candle, but this still screams for, so there's two scenarios that can come here, right? Either we move lower from here, right? Or we take out this previous day's low and push higher. This becomes your favored one. So you want to be looking for shorts on this next day. Bang. Your drawn liquidity gets taken out and then price flips. We close above all of this, right? We close above this previous day's high. We just about close above this. Next draw on liquidity becomes this previous day's high and potentially your distal line of your imbalance. Did we get divergence there? It's another thing to look out for. No, we don't. So again, we don't take that, right? But we get this dealing range, this inside bar. This becomes our drawn liquidity. So there's two scenarios we look out for. Price taking out this previous day's low and then pushing higher, or price just pushing higher. Bang, pushes higher, fails to body close above, right? So, and now look, higher time frame context, we're in the expensive area of our chart. We're anticipating price to start rolling over soon. So we don't really want to be going long here. We want to start looking for shorts. So we failed to body close above these highs, but we haven't got confirmed bearish PA yet. So ideally we want to be looking for these previous day's lows, but we know that it's not high probability just yet, but it's playbook theory. Cool. Now, what do we have? Now, again, here, you don't want to be buying into this level right here because you're in your opposing array. You're in your cheap, your expensive area. You don't want to be buying here just yet, right? So I wouldn't even suggest going to previous day's high here. You're looking at your lower time frames to catch shorts. Bang, you see? Because you look, you're in your EQ. You're in this expensive area on your chart. Okay, price prints lower. We failed to close below this, but we know price needs to expand this range. Next day's drawn liquidity becomes previous day's low. Bang. Again, previous day's low. Oh, sorry. Failed to close above. This would have been your draw to previous day's high, but this is a Monday. Again, there's so much context and understanding that needs to go into these play. You can't, the playbook alone isn't just some holy grail, right? Okay, here, previous day's low again. Bang. Here you could get previous day's low, but look how we close so high up in this wick. So you've got two scenarios, right? You wouldn't want to be going long here and calling bottoms. You want price to show you first. Cool, fails to close above. You're looking for some kind of short scenario here. Fails to close above again. Again, so what I want to make clear here is there's two scenarios that are quite low probability. When you've expanded some kind of sell side liquidity as such, and price starts to slow down, and you get your short playbook. So let me just make this a bit cleaner. So if you get some kind of bearish leg and then price starts to consolidate like this, and you get your bearish playbook somewhere here in your discount, this is low probability shorts, same as this, right? You're in the discount of this range. Going short in a discount is never a good idea. So your short playbooks that form in your discount are low probability, right? So short playbooks in discount are low probability. Short playbooks in premium are higher probability, right? I hope you're, sorry, excuse me. So if I can get my drawing tool, this was a short playbook, but it's low probability because you're in a discount. This was our previous range. This was a buy playbook, but it's low probability because you're in your premium. So buy playbooks in a premium are low probability. Sell playbooks in a discount are low probability. Sell playbooks in a premium are high probability. Buy playbooks in a discount are high probability, right? That's kind of what I'm trying to say. So in this condition, your buy playbooks are favored, your sell playbooks are not favored. When we pull back into that dealing range, your sell playbooks are favored, your buy playbooks above EQ are not favored. Make sense? I hope we've, kind of just, discussed a few things here and opened your mind into how you can use these tools. So I'm going to pull this back. So here, you'd be very cautious. Your sell playbook is playing out and you're in an array. So sell playbooks could set up to here, but you also want to understand that you're in a premium, that you're in a discount. So sell playbook calls for shorts, but your discount calls for longs. See, doesn't play out. Now, this is a buy playbook in your discount, which is what? High probability. So you can go long to this draw on liquidity. This is your draw on liquidity for the bang. You see? Very nice. Again, buy playbook on your next day. Why? What day is this? Tuesday. Buy playbook on your next day because we failed to close above. Well, in theory, you've got this, right? Which is your inside bar. We failed to close above. But again, shorting this becomes low probability because you're in a discount. So you'd probably still look for buy side over here. But you understand that if we don't just boom straight up, then we're coming lower to go higher, right? We're coming to take out this previous day's low to go higher. But this is your draw on liquidity. Cool. So now we take out the lower end. This was low probability shorts. So now we're looking at price to maybe take out this low, or just do something like this, right? So we've got two scenarios, this one or this one. You see? Cool. We failed to body close above, right? We failed to body close above this range and we've tapped EQ. So this is where it gets very sticky icky, and I know that price now just consolidates here. Yeah. Do you see why? Do you see why? Because it's that 50-50 scenario, right? Where you've got bullish recent PA, right? Of price stepping in this retracement, but you're now approaching your EQ. So you've got buyers meeting sellers as soon as we tap EQ. And that's what causes that stagnation. We need some kind of factor to come out that pushes price lower again. Anyway, I'm happy to wrap up this video here. 42 minutes long. I hope you guys enjoyed that. Very informative. And I can't wait to show you the next video, which will most likely be how to actually trade these on your lower time frames. So we'll zoom into the lower time frames and explain how to use these in a lot more detail. Peace.